In 2026, conflict in Iran triggered an immediate global energy shock. Oil prices spiked, markets fractured, and global supply lines strained under the sudden friction. While manufacturing and transport sectors across the economy absorb heavy losses, European oil majors like BP, Shell, and TotalEnergies are having an extraordinarily profitable year. During an energy crisis, the primary profit engine for these firms shifts toward oil they never pulled from the ground. Inside these companies sit highly secretive trading arms. Their entire function is to buy millions of barrels produced by rival companies and sell them into a panicked market at a premium. For every barrel they pump, they trade 5 to 10 barrels from outside sources, shifting 40 to 50 million barrels daily. This volume generates $15 to $20 billion in 2026 pre-tax profit, accounting for up to 20% of their combined total profits. In a typical trading business, luck runs out, and punters eventually take a hit. Yet, these internal divisions almost never lose money. They have engineered a system that reliably turns global geopolitical panic into corporate yield. American oil companies historically operated with a massive geographic advantage. They had access to vast domestic reserves and an internal consumer market ready to burn whatever they extracted. European firms lacked those domestic resources. During the 1970s, a wave of nationalization across the Middle East suddenly stripped companies like BP and Shell of their equity stakes in foreign crude. Left without sufficient wells of their own to supply their refineries, they had to adapt. To survive, European majors learned how to aggressively source and purchase third-party oil. By the 1980s, OPEC's grip on global pricing collapsed, flooding the market with cheap crude. BP began buying millions of barrels it didn't strictly need, betting it could sell them at a margin. An absolute lack of domestic supply forced the Europeans to build corporate muscles the Americans didn't need. They evolved into aggressive, highly capitalized buyers built to exploit an unstable market. Look at this graph illustrating an arbitrage spread. Traders profit from volatility, the widening gap between oil prices in different locations. When 2020 lockdowns erased global demand, crude prices famously crashed below zero. As the lines invert, the arbitrage zone expands. Because these trading desks are backed by the treasuries of global conglomerates, they could instantly lease dozens of massive tankers to store oil they were practically being paid to take off the market. They held the oil at sea until the lockdowns lifted. When prices eventually bounced back, they sold those stored reserves and minted billions in profit. The structure holds up even when traders guess wrong. When the 2026 bombings in Iran caught many desks betting on an oversupplied market, their financial backing allowed them to instantly liquidate their bad positions and play the resulting price swings to erase early losses. To a highly capitalized European trader, a collapsed supply chain or a localized war is a structural arbitrage opportunity. The teams executing these trades operate in a different reality from the engineers working on offshore rigs. They are housed in global hubs like London or Geneva, operating as independent units that hire specifically for high risk tolerance and extreme social fluency. They maintain regional offices positioned near major logistical choke points like Singapore. Here, specialists cultivate first-name relationships with local ship owners, airline executives, and regional refiners. The decisive advantage for these traders comes from the proprietary intelligence generated by the parent organization's own physical footprint. Because their parent companies physically own and operate thousands of active oil fields, storage terminals, and massive refineries across the globe, the trading desks receive an uninterrupted flow of proprietary data. They know exactly how much product is flowing through a specific pipe or sitting in a specific tank on any given day. This physical footprint acts as an intelligence network, giving them exact supply and demand figures long before independent banks see the data. That multi-decade dominance has attracted rivals. Competitors are aggressively spending capital to close the gap and capture the volatile margins the Europeans enjoy. American giants like Exxon, alongside petrostates like ADNOC and Saudi Aramco, have become the most aggressive recruiters in the market, poaching top-tier European talent to build out their own desks in Houston and Geneva. Yet industry insiders liken building a trading desk to running a Formula One team. You can hire the best drivers, but refining the telemetry, adjusting the strategy, and getting the data integration right requires hundreds of iterations. A competitor can buy a successful trader today, but they cannot immediately purchase the deep institutional memory required to cleanly navigate extreme crisis volatility. The European majors know how to defend against new entrants. Their real threat comes from massive, independent private trading firms like Vitol and Trafigura. Publicly listed European majors face intense pressure from shareholders and governments to cut their carbon emissions. To meet those targets, they have been forced to systematically sell off their physical infrastructure. BP, Shell, and TotalEnergies offloaded $77 billion in physical assets since 2019. These nodes represent active refineries moving to independent hands. When private firms buy a terminal, they acquire its data. The majors are selling off the physical sensors forming their intelligence network. Without public shareholders to answer to, these private competitors can also move faster, taking on highly lucrative, legally complex trades involving sanctioned countries that publicly listed companies avoid. The geopolitical friction driving today's prices guarantees heavy profits for the European desks in the near term. But as they surrender the physical assets that give them their sight, the structural advantage that built their trading empires is quietly slipping away.